Hello and welcome. You're watching The Big Story on NDTV Profit. This is a special show on the GDP numbers that will be released very shortly. I'm in conversation with Dharmakirti Joshi, Chief Economist at CRISIL, and Radhika Rao from DBS. Thank you so very much to both of you for taking time out for us today. So, Radhika, I'll start with you first. What are your expectations on the numbers? They should be coming out just about any moment now. What is your expectation from the headline number for the full fiscal year as well as for Q4?
Hi, Pallavi. Thank you so much for this opportunity. So I think the growth number that we expect in Q4 is going to be around 7%. This is for the real GDP. And what we expect behind that 7% is non-farm output, essentially helping growth, generally on the expenditure side. So we're going to see industrial growth. I think it's going to moderate a bit from the quarter before, but nonetheless, it's going to be still strong. And then you've got services.
Quickly interrupt you. So the real GDP growth has come in at 8.2% for FY24. That is significantly, or at least marginally above estimates. And real GVA growth has come in at 7.2% for FY24. GDP growth compares to a figure of 7% for FY23. This happens to be, I think, the third straight year that India's GDP has been in excess of 7%. Or in line with 7%. GVA growth too very strong at 7.2% for FY24. For Q4, real GVA and real GDP have been estimated to grow by 6.3% and by 7.8% respectively. That's again higher than estimates. So Radhika, I'll quickly come back to you. Key takeaways, once again a set of numbers that have surprised on the upside.
Yeah, certainly, Pallavi. I think this has become quite a trend.
Absolutely.
Even better than market expectations, better than consensus, better than the most optimistic forecast out there.
That's true.
But we'll be keen to see what's underlying. But I think on the annual year basis, it's pretty much in line with what we were expecting, which is at about 8%. So the actual seems to have come about 8.2 for the real GDP. And the gap between real GDP and GVA was supposed to be in place because of the tax payouts as well as the low subsidy disbursements. So that gap has been quite wide. And we had noted last time that it's in many quarters that you actually seen this kind of a wide wedge. I think it showed up first in the Q3, fiscal 24 number when we saw it last. That's October-December number. Not surprisingly, that's obviously influenced the whole year as well, seems to have also played its part in the fourth quarter of fiscal 24. But I think there'll be some election impact, early part of the election impact also filtering through the last quarter of the previous fiscal year. So we'll wait and see how that's impacted some of the subcomponents. But overall, I think a very strong number, I think, continues to show that India's growth is among, better than most of the major economies in the world, certainly finishing fiscal 24 on a very strong note.
Absolutely. And before we go to Mr. D.K. Joshi, I'll also quickly go through the quarterly estimates. And this time around, we actually have industry-wise breakups as well for the primary sector, secondary sector, and tertiary sector. Let's quickly go through what that's looking like. Agricultural GVA has come in at 0.6%. I would say fairly in line with expectations. We were not expecting a strong figure there. Mining and quarrying has come in at 4.3%. That is actually lower than 7.5% that we saw in Q3. Coming to the secondary sector, on an aggregate, it's grown by 8.8%. Again, a scorching number there, led by manufacturing, which has come in at 8.9%, whereas electricity and utilities have come in at 7.7%. And construction has come in at 8.7%. So that's a great set of numbers in the secondary sector. In the tertiary sector, That's grown by 6.7%, with trade, hotels, transport, communication having grown by 5.1%, financial, real estate and professional services having grown by 7.6%, and public administration having grown by 7.8%. So at least in terms of trends, we did expect agricultural GVA to underperform in Q4, and the secondary sector and the tertiary sector to lead growth. That's pretty much in line with what's happened, but clearly the standout here is the secondary sector, manufacturing as well as construction, having grown at about both at well over 8.5% actually. I'll quickly come to you, Mr. Joshi. What's your quick takeaway and your early thoughts looking at these figures?
Well, this is the direction is on expected lines, but the growth came out stronger than we had expected.
Right.
So I think one should note that the non-agricultural economy has been extremely resilient and extremely resilient to global shocks. Agriculture was a monsoon-related shock, and agriculture growth was supposed to be low this year, and I think that's what it came. But I think the story is the non-agriculture side of GDP. And I think some indications were there that the fourth quarter is going to be strong because the PMIs for manufacturing, PMI even for services was reasonably strong. So I think this is basically confirming the resilience of the economy. And by the way, if you look at the first advance estimates, second advance estimates, and now these numbers, I think every time I think the revision has been to the upside. And so the GDP continues to surprise positively.
All right. Okay. Agri-GVA, a little bit of a sore figure, especially given how secondary and the services sector have panned out. Can we expect, so far looking that we are expecting normal southwest monsoons, can we expect a little bit of a turnaround in agri-GVA going forward for the ongoing fiscal? Radhika?
Yes, I think the outlook-wise, there are some things that are certainly falling into place, and some parts that are not. I think the early part of fiscal 25, we are still in midst of heat wave that's affected quite parts of the country. I think off late, north and northwest. So that I think impact will show in perhaps the first part of fiscal 25. But outlook-wise, I think one can be very optimistic. We are seeing conditions evolve for El Nino to be dissipating, La Nina to be setting in. The IMD has already spoken about expectations of a normal monsoon, and you already seen the early showers in place. So certainly very encouraging. As monsoon onset, you and I would be, of course, tracking how the spread is, because some of the months in the southwest monsoon are more important than the others. So we need to see if those months, the boxes are ticked, and then you also have which regions are getting how much rain through these next 3-4 months. So that will become important overall to gauge the requirement. And it's very necessary because if you see the reservoir levels and groundwater levels, they are below where they were at the same time last year. Certain parts of the country, the shortfall is even higher. So that's why so much more attention on monsoon this year than otherwise. And I think it's made its way also into the RBI's comments, for example, who have been talking about climate change as a potential problem for food price outlook going forward. But a better faring monsoon means better crop output, also by extension would mean better rural incomes, because we had seen rural demand actually begin to come back in the late part of calendar year 24 and calendar year 23 and early part of calendar year 24. So certainly a good multiplier effects if agri output holds up this year.
All right. Okay. And coming to expenditure-wise trends, private consumptions actually come in at about 4%, while government final consumption expenditure is at about 1%, while capex is at 6.5%. Mr. Joshi, your takeaways on that? Private consumption's, of course, been a little bit of an Achilles heel in FY24 for India's economy. Is this figure in line with expectations? Are we expecting signs of improvement going forward?
Well, I think so. This 4%, I'm presuming you are giving the full fiscal year number, because the earlier quarter number. Okay, because what is the full fiscal year number? Because the The earlier number was around 3%. Yeah, we do expect private consumption to improve in 24-25. And I think the reason for that is the one is the rural side of the economy will do well, I think, as Radhika was pointing out. And agriculture will actually surprise because it's grown much below the trend in 23-24. So you will get a base effect and you will get a monsoon effect. So both of them actually agriculture GDP can be easily 6 to 7% if monsoons play out well in terms of the quantum of rain, in terms of its distribution, regional as well as over time. And I think the consumption part, particularly in the rural area, will get a lift as a result of this. Urban consumption, I think, will be somewhat slower in 24-25 because the urban consumption gets hit by the interest rates. I mean, the rural doesn't get hit that much by the interest rates because of the credit penetration. So I would say that, yeah, I think overall consumption will still hold, but that said, investments will continue to be the driver of growth even in 24-25.
Okay, all right. Radhika, coming to capital formation, about 6.5% growth there for Q4. And of course, one interesting trend Mr. Joshi pointed to was the fact that in FY25, we could see things working out the other way, with rural possibly picking up some of the slack from urban consumption. Is that in agreement with how you look at it as well? And also at 6.5%, can we now, we have more reasons to believe, given recent trends in capex, that private capex is finally picking up? Is that the sort of right way to look at it?
On the year, of course, the quarterly number, like you rightly mentioned, about 6.5%. But if you take the entire fiscal year, I think the broader trend that all of us are paying attention to is that capex is, investment growth is certainly growing investment growth is at a much faster pace than consumption. Now, this kind of cycle had happened, probably 2004, 2006, that kind of phase where you had seen a sustained increase in the investment growth, compared to consumption. I think that's repeating itself. I would think that would also go ahead and extend into fiscal 25 as well. But if you look at the drivers behind this capex growth, certainly what is important is what the government is doing. I think the center has already allocated quite a substantial amount. I mean, 25% growth in the last couple of years, and then you've got more in the year fiscal 25 interim budget. When the final one is laid, I would personally expect similar numbers to be maintained, in terms of being more capex heavy. Then you also got the states which are working alongside. Apart from just the public sector, you also have households capex that's really picked up. And I think, again, that is quite encouraging because it means real estate and construction also being quite a labor-intensive industry would have positive multiplier effects for the economy. So the household capex as well as the government capex certainly working in cohesion. Private corporate, in our conversations with companies, it certainly seems to be that they're contemplating putting in fresh money, but they really need to see some more things fall into place. So they haven't really gone big on that front, barring sectors which are very closely related to what the government is doing. So for instance, and so all of this is just the regular cycles, and then you've got, of course, the elections. So for instance, if you see some of the infra-related firms, they did have a good pipeline, but it moderated somewhat in the fourth quarter of fiscal 24, just ahead of the election. So I think you will see that again happen in this quarter as well before it really takes off. So early part of the year, somewhat impacted by the election cycle. But once results are out, we are going to see some of that come back. So capex, it's a bit still partly private, mostly public sector, but private corporate, I think, is still to participate fully. But one can hope that, as Mr. DK mentioned, if consumption fares better, then there will be one more factor that could draw in the corporate sector, which is at a very healthy position at this point, as insofar as its own books are concerned.
Right. Okay. Mr. Joshi, coming to you, a couple of things. You were talking about the full year trends for private consumption. That's also come in at about 4%, while capex, I mean, broadly, these figures too seem to be in line with what we've seen for quarterly figures. Capex, private capex has come in at about 8%. The capital formation bit, private consumption at 4%, and government expenditure lagging compared to both of these. Quick thoughts on those, and I also do want to ask you about the GDP GVA divergence that we continue to see in quarter 4. We were, I believe, expecting the divergence to have narrowed in quarter 4, considering the subsidy outgo was lower. What are you reading into the GDP GVA divergence? Also, the fact that while GDP growth is 8% plus and GVA growth is clearly below that by a fair amount, does that have to sort of be kept in mind when we're reading the GDP figure and when we're trying to understand what really the state of the economy is from these figures?
Well, I think first of all, we have decided now, I think, that GDP will work with GDP numbers. So GVA also gets released, and I think earlier we used to focus more on GVA. It is regarded as a more firm estimate. But having decided that we'll focus on GDP, so I think we should be looking more at GDP. Now the discrepancy is because of the net taxes, I think, which will correct, I think, in 24-25. So you'll see some kind of convergence between GDP growth and GVA growth happening in the coming year. So I would still focus on the overall GDP number. And I think in addition to that, I think there is also deflators at play. I mean, the high manufacturing growth is also a result of extremely weak deflator in that because the WPI inflation which has a higher weight in the deflator, was almost close to zero. So I think there are several factors which are creating the some sort of divergence. But I think going back to your previous question of investment, I think here we see private investments very gradually pick up, and I think there is a dichotomy within private investments also, as Radhika was pointing out. The steel, cement segments, which are directly linked to what government is doing, they are very strong. But in addition to that, I think there are newer segments in private capex which are coming up, which will increasingly play a bigger role in the industrial capex story going ahead, which is electronics, semiconductors, electric vehicles. I think this is where the interest is, and the next sector for which we'll see action from the private capex side is going to be the auto sector. I think there is a lot of capex lined up there. So I would say that it's going to be a cautious pickup in capex, unlike the capex pickup we saw after the global financial crisis, or even before the global financial crisis, which actually later on turned out to be there was a lot of froth in that investment, and we got a lot of NPAs out of that. So this is not playing out this time, and because of the IBC and NCLT, so there is it's more genuine capex. That's what I would say. So I would believe that the gradual lift in capex, private corporate capex will continue. So far, I think the higher role has been played by government capex and household capex. Government will continue to play a role even in 24-25, maybe higher than what they had indicated in the interim budget, because now they have more fiscal leeway because of this dividend, 2.1 trillion rupees dividend transfer from the government, which gives them more somewhat enhanced ability to focus on capex, I mean, going ahead. So we could see the overall capex continue to strengthen even in 24-25.
Okay, all right. So gross capital formation did actually come in at 8.9%, almost 9% actually for the full fiscal year, while private consumption was in line with what we saw for the quarter, both at about 4%. I do want to understand your perspective as well on the GDP GVA divergence and what you make of the divergence, and if we can expect the divergence to narrow going forward.
Yeah, I think I'll just I think Mr. Joshi largely spoke about that gap, which is a function of taxes and subsidies. So they routinely are affected by a few things. Sometimes towards the end of the year, you see subsidies being allocated at a faster pace. This time around, I think on the taxation front, certainly as you've been seeing in the trickle of news in the past few weeks, the taxation collections, direct tax collections, indirect tax collections, as well as one-off non-tax revenue sources like the RBI's transfer of surplus has left the government with a very good revenue buffer. So sometimes these things can distort, what the real GDP looks like. But we would also think that this doesn't usually last beyond 2-3 quarters. So we would expect a convergence of sorts going into fiscal 25. And usually when we have seen a long-term average, it's about 20 or 30 basis point gap between the GV and GDP. So certainly this is much wider than that, and we wouldn't think this would last for too long. But going into the expenditure components, it will be very important to see again that, for instance, we did discuss the capex and consumption part, but what's happening to trade as well, because after a long time we used to discuss a lot on the goods and goods trade deficit in India's case, but services have become a very big force to reckon with. In fact, the services trade surplus has continued to hit record highs and helping to a great extent to offset what's happening on the goods side. So what advantage that carries is that you're going to see trade in general being a lesser of a drag on the growth metrics, right? Usually we used to have net exports being eroding or taking away from growth, or a negative contributor, so to speak. But you're going to see that turn positive over the next couple of years because of the, again, the manufacturing footprint, improving composition of goods exports as well. We have seen petroleum shipments, chemicals, drugs, and pharma plus electronics become a much bigger part of the pie than, say, 5 years back. So I would think the composition will pretty much go back to, or the discussion will pretty much go back to what's driving growth from the expenditure end, as obviously equally important is what's happening on the supply side. But we're hopeful that, going forward, the outlook wise, you've got global growth is in fact looking a bit better than it did late last year. China is expected to grow at a bit of a faster pace. US growth is 2.5%. Europe is also finally coming out of its stagnation. So domestically and globally, we would think there are reasons to be a lot more optimistic.
Okay, all right. So broadly continuing with that, Mr. Joshi, also given that we've recently received the RBI's projection for FY25, yet another year of about 7 or 7+% growth, and looking at recent high frequency indicators, we've also seen core sector data come in at 6.2% for the month of April. Safe to say economic momentum seems to be carried forward on a sequential basis. It continues to remain strong and resilient. Would that be the right takeaway?
Yeah, I think the data that we have seen for April and May, I think for May it is only PMIs. I think that's indicating a very strong momentum. And and tax collections have been very healthy for the month of April, and that GST collection that may continue in the month of May as well. But I think I should also mention that if you look at the budgetary projections on taxes, the growth is much slower than what we achieved in 24-25. So there is going to be some, I think, moderation in tax growth, which is consistent with our projection that growth will moderate in 24-25 from the levels that it has seen in 23-24. Our existing forecast is 6.8% for 24-25, and I think the two factors which are pulling it down. One is the central bank raises interest rates to slow the economy, and I think now the peak impact will be felt, and rate cuts are not going to happen anytime soon. And then I think the fiscal impulse is also somewhat lower than what it was in 24-25. So we will see some impact of that. And as Radhika was pointing out, I am actually quite hopeful on the trade front, particularly the goods trade, because global trade cycle is, in volume terms, is also expected to pick up. I mean, the World Trade Organization is talking about a pretty sharp increase in manufacturing trade. The supply chain data which S&P collates, is also telling you that the supply chains globally are operating at near full capacity, which is good for the manufacturing activity. So I think there are indications that two things happening here. One, the global growth remaining resilient, and on top of that, its trade intensity of growth is expected to, goods trade intensity is expected to rise. So I think you'll get some support from exports as well in 24-25. So overall, I think if you go by 6.8%, which is our projection, that's a very high rate of growth. I think over a very high base. So.
Okay, and before we close the discussion, we do have to touch upon the FY24 fiscal deficit as well. That seems to have come in at about 5.6% of the GDP. So the government's revised fiscal deficit target for FY24 was actually set at 5.8%, and there were expectations that we might actually perform better than that. So this figure is not entirely a surprise, but Radhika, quick closing thoughts on the fiscal deficit figure, and clearly yet another sort of piece of good news as we wrap up the day and the discussion, right? What are you making of that? And do you think that can possibly have implications on the government's fiscal deficit target for the ongoing fiscal year as well? When we see the next budget, will the government, especially, given that the finance minister has said that the outlook change by S&P has been encouraging, we do know that the government has been focusing on fiscal consolidation. All of these factors taken together, what are we looking at in terms of fiscal consolidation? Will it be quicker than was earlier anticipated?
I think that's quite interesting because, in the past, if you remember, when we used to talk about fiscal consolidation, it usually used to be a result of pullback in expenditure towards the tail end of the year. But you do know, when you look at the capex numbers or capital expenditure from the government, high frequency, it showed that even in the final quarter of the year, the expenditure was still ongoing. It's encouraging that it's coming from higher revenue generation and not so much expenditure pullback in fiscal 24. So from that angle, as well as a robust nominal GDP number, it's encouraging that it's come out about 5.6%, as you rightly pointed out. Now going into 25, we're really on a stronger footing. Again, as revenues are concerned, there is a buffer of at least 0.3, 0.4% of GDP insofar as additional revenues are concerned. Interim budget, I think the revenue tax projections were, as they have been of late, quite conservative.
Right.
Buoyancy of about 1 is considered. So I think there is quite a likelihood that we are going to get at sub 5% in fiscal 25.
That will indeed be worth watching
S&P
out
has
for.
Already acknowledge that, so we would think faster consolidation is certainly ahead of us.
Okay, great. Thank you so much for that. With that, we're completely out of time. But once again, Mr. D.K. Joshi and Radhika, thank you so much for taking time out for us. Stay tuned to NDTV Profit for our continuing coverage on today's GDP figures, fiscal deficit figures, and a lot more. We have more coming up for you on the other side.